Picture this. Your portfolio is down 10%, maybe 20%. The numbers are red. Your heart starts to pound. Your stomach tightens. And a little voice in your head, urgent, insistent, whispers, "Get out now, before it all goes to zero." That voice feels like it's looking out for you, like it's the smart move, like it's the only rational response to what you're seeing. But I'm here to tell you that voice is lying to you. And it has been lying to investors for as long as markets have existed. That's not your investor's instinct talking. That is your ancient survival-wired brain, the one that evolved over hundreds of thousands of years to keep you alive in a dangerous physical world. And it has absolutely no business managing your retirement account. This is the story of why that panic button drives people to sell at the worst possible time, and what the historical data shows happens to the investors who learn to ignore it. Before we go further, I'm not a financial advisor, and nothing in this video is personal investment advice. This is purely educational, based on historical data and behavioral research. Let's get one thing straight. First, that gut-wrenching fear you feel when your portfolio turns red. It is completely real. You are not a bad investor for feeling it. It is a feature, not a bug, of being human. And understanding where it comes from is the first step to stopping it from costing you money. The problem is this. Our brains are essentially ancient hardware, running brand new financial software. For almost all of human history, hundreds of thousands of years, the world was immediate and physically dangerous. A sudden threat in the environment wasn't a data point to analyze. It was a life or death situation that demanded an instant response. So, our brains developed a powerful hair-trigger threat detection system. Deep in your brain sits the amygdala, your mind's alarm center. When it detects danger, it floods your body with adrenaline and cortisol. Your heart rate spikes. Your vision narrows. Your thinking becomes fast, reactive, and binary. Run, fight, freeze, survive. That system saved our ancestors' lives. In a world of physical predators and environmental threats, it was exactly what was needed. The problem is, your brain has carried that same system into the 21st century, and it cannot tell the difference between a charging predator and a charging bear market. When your screen fills with red arrows and falling numbers, your amygdala fires the same alarm it would for a genuine physical threat. Your body responds the same way. The same adrenaline, the same urgency, the same desperate need to do something. Right now. To make the danger stop. And here is exactly where the trap is set. Because in the physical world, acting fast saved your life. But in the financial world, acting fast on panic almost always costs you money. Your survival instinct becomes a wealth destruction instinct, and it has taken down experienced investors for generations. So, what actually happens when you obey that primal urge to sell? You do something that feels safe, but is financially devastating. You convert a temporary, on-paper decline into a permanent, realized loss. Think about it this way. Imagine you own a house. 1 month, a real estate agent tells you the estimated market value of your home has dropped by 15%. Has your house changed? No. Has your kitchen shrunk? No. Has the roof caved in? No. The house is exactly the same. The only thing that changed is an estimate of what someone might pay for it today. You haven't lost anything unless you sell. The moment you sell at that lower price, you've made the loss permanent. You've turned a temporary fluctuation into a locked-in reality. Stock market declines work exactly the same way. A portfolio that is down 20% on paper represents the current market price of your ownership stake in real businesses. Businesses that are still operating, still generating revenue, still innovating. The decline in price does not change those underlying facts. What changes is market sentiment. And market sentiment, as history has shown repeatedly, recovers. The only way a paper loss becomes a real loss is if you sell. And the data on what happens when investors sell during crashes is clear and consistent. Let's start with the most severe market crash in modern memory, the 2008 global financial crisis. From its peak in October 2007, the S&P 500 fell nearly 57%. To its trough in March 2009. These figures are based on historical index performance and are for educational context only. Past performance does not guarantee future results. Not a dip. Not a correction. A 57% collapse. That unfolded over 17 months of relentless, grinding fear. Lehman Brothers filed for bankruptcy on September 15, 2008. Widely considered the moment the crisis became a full-scale panic. By that point, the market had already fallen roughly 20% from its peak. And it still had a long way to fall. Investors who listened to their panic and sold near the bottom thought they were being smart. They thought they were protecting themselves. What they were actually doing was converting a frightening number on a screen into a permanent, irreversible financial loss, and then locking themselves out of the recovery. Because here is what happened next. An investor who bought a broad S&P 500 index fund on the day Lehman collapsed still watched their investment fall another 40% before the market bottomed. That was a genuinely brutal experience. There was nothing easy about it. But if they did nothing, if they simply held on, their total return, including reinvested dividends, was approximately 195% over the following 10 years. Nearly triple their money. Not from making a brilliant call, from doing nothing. The same lesson plays out in every major downturn. The dot-com crash of 2000 to 2002 saw the S&P 500 fall approximately 49% over roughly 2.5 years. Slow, grinding, and demoralizing. Investors who sold near the trough in October 2002 and waited for things to feel safe before getting back in missed much of the subsequent recovery. Those who stayed invested in diversified index funds saw a full recovery within 5 years and meaningful gains over the following decade. And then there is 2020. The global pandemic sent the S&P 500 down roughly 34% in just over a month, one of the fastest declines in market history. Pure, unfiltered panic. And completely understandable. This was a global health emergency, unlike anything most investors had ever experienced. But investors who stayed the course, even those who did not catch the exact bottom, were rewarded. From the start of 2020 through the end of 2021, the S&P 500 delivered a total return of over 50%. That includes the crash. Staying invested through the chaos produced better outcomes than fleeing and waiting for calm. The pattern is remarkably consistent. across every major market crisis in modern history. Patient, diversified investors who remained invested have recovered and gone on to build long-term wealth. Those who sold in panic locked in their losses and frequently missed the recovery entirely. This does not guarantee future results will follow the same pattern, but the historical evidence is difficult to ignore. Keep in mind, these are historical patterns, not predictions. Every market is different, and individual results will always vary. So, if the historical data is this clear, why do smart people keep making the same mistake? Why do intelligent, educated investors keep selling at exactly the wrong time, decade after decade? Because it is not an intelligence problem. It is a wiring problem. Two deep cognitive biases make panic selling feel not just reasonable, but necessary. The first is loss aversion. Research by Nobel laureate Daniel Kahneman and his longtime collaborator Amos Tversky found that losses feel approximately twice as painful as equivalent gains feel pleasurable. This principle sits at the heart of their landmark prospect theory. Losing $1,000 hits far harder emotionally than gaining $1,000 feels good. What this means in practice is that your brain is powerfully and disproportionately motivated to stop the pain of a declining portfolio, even if stopping that pain means selling at a loss and missing a recovery worth far more than the short-term relief. The desire to escape the sting of loss overrides the rational calculation of long-term reward. Every single time a market falls, millions of investors experience this, and many of them act on it. The second glitch is recency bias. The tendency to assume that whatever has been happening recently will continue to happen. When markets have been falling for weeks, your brain starts to believe they will fall forever. When a crisis dominates the headlines, it feels permanent. But market history does not support that feeling. Every bear market in the history of the U.S. stock market has eventually ended. Recency bias makes the current crisis feel uniquely permanent, when, almost never, it actually is. And then there is herd mentality. During market extremes, the sharp crashes and speculative bubbles, investors cluster around the same behavior. When fear spreads, the impulse to follow the crowd feels like safety. But during market panics, the crowd is doing the one thing that history shows to be most costly: selling at the bottom. As Warren Buffett has said, be fearful when others are greedy, and greedy when others are fearful. That is not advice to pick a market bottom. It is a reminder that your instincts will be loudest, precisely when following them is most expensive. If our brains are wired to work against us in these moments, are we doomed to keep repeating the pattern? Absolutely not. Because the moment you understand the mechanism, you can build a system to override it. You cannot eliminate the fear response, but you can stop it from controlling your decisions. I want to be clear, I am not a financial advisor, and none of this is personal investment advice. But these three principles reflect the behavioral framework that underlies much of long-term investing philosophy. And they are practical, actionable, and free. The first principle is the 48-hour rule. The market is falling. You feel the urgency to act. Here is your rule. You are allowed to feel the fear, but you are not allowed to make a sell decision for 48 hours. Think of it as putting your emotions in a mandatory timeout. Adrenaline has a biological half-life. The acute stress response that makes selling feel urgent typically fades within hours, not days. After 48 hours, you can revisit the situation with a genuinely clearer head. And the desperate certainty that you must act right now will almost certainly have softened. Most panic-driven sell impulses do not survive a 48-hour cooling period. That pause is your emergency brake, and it costs you nothing to use it. The second principle is to decide your rules in peacetime. A commercial pilot does not invent emergency procedures in the middle of a crisis. They follow a checklist, carefully designed, tested, and memorized on the ground, before anything went wrong. Your investment strategy should work the same way. Before the next crash happens, right now, while the market is calm, write down your plan. What are you invested in, and why? What is your time horizon? What would genuinely justify selling? A fundamental change in a company you own? A planned near-term need for the cash? Write those conditions down. Make a contract with your future self. When panic arrives, you do not make decisions. You execute the plan you made when you were thinking clearly. That separation between calm time planning and crisis time execution is one of the most powerful tools in long-term investing. The third principle is to look less. This one is simple and backed by behavioral research. Investors who check their portfolios more frequently make more trades. More trades, driven by short-term fluctuations, lead to worse long-term outcomes. The relationship is that direct. Your long-term portfolio is not a slot machine. Checking it daily or hourly during volatile markets does not give you useful information. It gives you noise. And noise feeds your amygdala. Remove the stock app from your phone's home screen. Commit to reviewing your investments once a month or once a quarter. If your investment thesis is long-term, your reference point should be long-term. The less real-time noise you allow in, the less power your ancient threat detection system has over your modern financial decisions. Your brain is not your enemy, but it is a genuinely terrible financial advisor. It is a survival machine built for a world of immediate physical threats, a world where the right response to danger was always fast and decisive action. That brain saved your ancestors. In the stock market, following its instructions without question has cost investors trillions of dollars over time. That primal fear, when it arrives, does not have to be a sell signal. It can be something else entirely. It can be a signal that your discipline is being tested. A reminder that you are in exactly the kind of moment where your plan matters most. A marker that you are living through the kind of crisis that, historically, has preceded some of the strongest periods of long-term market growth. By using simple behavioral guardrails, the 48-hour rule, deciding your strategy in peacetime, reducing the noise you let in, you create a firewall between your emotions and your money. You build a system that honors your long-term goals, instead of caving to short-term fear. History does not guarantee that markets will always recover. Past performance is not a promise about the future. But what history does show, consistently, is this. The investors who have built lasting wealth are rarely those who predicted the market. They are those who built a plan, held to it under pressure, and recognize that discipline, not prediction, is the foundation of long-term financial success. Stop listening to the panic. Start listening to the plan.